The following market update content was created by Ivan Gruel, Chartered Financial Analyst and Chief Investment Officer at Avantax. These views are as of close of business on March 2nd, 2023, and do not reflect the recent events within the banking industry.
Hello, my name is Sandeep Varma, President and CEO of ATS Wealth Management. Today, we will provide a market update for March. We'll start with a recap of return for February and then shift to discussion on the Fed's fight against inflation, fourth quarter earnings, and where we see an opportunity for investors going forward. Following a strong rally for both stocks and bonds in January, the month of February has proven much more challenging. In the U.S., the S&P 500 index fell about 2.4%, while the Bloomberg U.S. Aggregate Bond Index fell nearly 2.6% in total return. International markets represented by the MSCI ACUX US Index suffered losses as well, falling 3.5% in February. However, despite the recent sell-off, both international and domestic stocks remain firmly in positive territory for the year, both up around 4% in total return. On a sector basis, technology was the only sector in positive territory during the month, edging out a modest 0.41% gain. Sectors like energy and utilities were among the worst performers, following a year of strong outperformance in 2022. Market performance in early 2023 continues to be driven by key ongoing themes, specifically the Federal Reserve and inflation. Following higher than expected inflation reading over the past month, the Federal Reserve interest rate hiking cycle is likely to continue through the first half of the year. As this chart shows, the January consumer prices CPI reports a deceleration inflation as headline CPI rose 0.5% for the month and 6.4% on an annual basis. A rebound in energy prices boosted headlines inflation, while higher prices for car insurance, clothing, and furniture also contributed. Shelter or housing inflation accounted for nearly half of the monthly increase. Also, the preferred measure of inflation for the Fed, the Personal Consumption Expenditure (PCE) Price Index, showed a surprising increase over the month. Annual inflation continues to trend downward, but at a much slower and uneven pace. In response to high inflation, the markets are now expecting the Federal Reserve to hike interest rates by at least another 0.75% or 75 basis points this year. We believe the most likely path will be 3 consecutive 25 basis points hikes taking place in March, May, and June. This would leave the upper end of the federal fund rates around 5.5% by mid-year, notably higher than the markets were expecting heading into this year. In response, interest rates across the board moved markedly higher over the course of the month. After starting the month of February around 3.4%, the yield on the 10-year Treasury note finished the month trading around 3.95%. In addition, yields on one-year Treasury is now sitting north of 5% for the first time in 15 years. On the earnings front, corporate profits came in about 2% lower for the fourth quarter of 2022. Downward pressure on profit margin remains a key issue for corporations. As this chart shows, operating margin declining from 13.4% in the fourth quarter of 2021 to about 11% during the fourth quarter of 2022. At the sector level, energy and utility both delivered strong earnings on the heels of higher oil and gas prices. However, sectors like consumer discretionary and technology experienced a tough quarter as higher labor costs and waning consumer confidence weighed on profits. The economic landscape is very similar to what we've noted on the earnings front. Certain parts of the economy, such as labor market and consumer spending, remain quite strong. Meanwhile, other parts of the economy, such as housing, have fallen victim to higher interest rates and inflation. In terms of investing opportunities, global equity valuations are now at a much more attractive level following last year's sell-off, and we see ample opportunities for investors willing to ride out the ups and downs of this unpredictable market. Encouraging sign from China's reopening combined with falling dollar and steep valuation discount should bode well for investors holding international stocks. In bonds, with a sharp move higher in interest rate recently, we see a longer-term taxable and municipal bond as providing attractive entry points for investors searching for generous income and balance in their portfolio, with higher interest rates providing a buffer to any change in yields. So that's what we have for you this month. Thank you again for watching, and thank you for the trust and confidence that you have placed with us, and we'll see you next month.